IVM.
Paytm Money has built a completely digital investing experience where you can start investing in mutual funds in minutes. Yes, that's right, in minutes. Seriously, guys, no paperwork required. If you're investing for the first time, you can download the Paytm Money app and complete your KYC verification in less than 30 minutes. If you're an existing investor in mutual funds, you can enter your personal details and start investing in just a couple of minutes. That's it, folks. That's all it takes to get started on Paytm Money. So go to the Play Store or the App Store and download this app because smart investors choose Paytm Money और अब म्यूचुअल फंड्स के लिए भी Paytm करो. Coming up next on this episode of Paisa Vaisa, investing in interesting times. Yes, I get the reference to the Chinese curse, guys, but we all know the times that we're living in right now, and I know that a lot of you have a lot of questions on just making sense of what's going on in the markets, on the investment front, and generally making sense of things. My guest, Radhika Gupta, CEO of Edelweiss AMC. We're going to do this on a Zoom call. The audio quality might not be that great because, well, we're not in the studio, but we hope to be back in the studio soon. I hope that your best wishes are with us, and I hope that all of you are staying safe. So coming up next, really special episode of Paisa Vaisa.
Hey everybody, welcome to another week on the IVM Podcast Network. I'd like to thank our sponsors, Paytm Money Upfront. Guys, we're heading into week 2 of the lockdown, and I'm sure it's been challenging for all of you, just as it's been for us. We're doing our best to make sure that we maintain our schedules, but beg your indulgence if we slip. In the meantime, if you're looking for more stuff to listen to, might I suggest you go dive into the archives. We've got over 6,000 episodes of content we've created over the last 5 years, and I'm sure there's something in there that you'd love listening to. And with that, let's get you back to your show.
Folks, welcome to Paisa Vaisa. I'm your host, Anupam Gupta, B50 on Twitter. And, well, the show must go on. These are extraordinarily tough times, something that a lot of us haven't seen. This environment, I mean, it's been compared to the World War, so it's tough. And I hope that all of you, your near and dear ones, your families are all staying safe in these difficult times. And a special thank you to each and every one from our authorities, whether it's the BMC or the police, the state government or the central government, whoever is on the front line, all the doctors, all the medical staff, all the volunteers, whoever is on the front line, our deep-hearted thanks to all of them. You are our heroes. So, folks, to go through these tough times and especially what's happening in the markets, as you would have seen, every day is just some kind of crazy moves, plus 5%, down 5%. And a lot of it doesn't even make sense. This quarter, the quarter ended March, has been one of the worst since the 2008 crisis, because this is, well, to repeat the word, a crisis. And to make sense of this, to tell us what you should do, what you shouldn't do, and how to read things going forward, I have with me a really special guest, a returning guest. I'm really happy to have her on the show, Radhika Gupta, CEO at Edelweiss AMC. If you're following her on Twitter, you would see that her timeline is thankfully full of positivity and a lot of advice. Hats off to the Edelweiss team because they're doing a lot of communication with all the investors and everywhere to just, navigate these very difficult times. So let's start with this recording. It's, I don't want to call it the market meltdown special, but we'll figure out the title later. But let's start with this. Radhika, thank you so much. Thank you for for doing this. I wish we were in the studio, but we're not. You're in your home. I'm in my home. We're doing this over Zoom. For folks, the quality of this audio recording might not be the great, but we're doing the best we can. Radhika, welcome to the show. Let's start off.
Thank you. Thank you for having me. I realize I'm a third-time returning guest on my show, so thank you.
And thank you for that.
Listener, thank you to you and your listeners for tolerating me multiple times. And as you said, we are doing this. I think it's extraordinary that we can still manage to do this, instead of in your studio sitting in our T-shirt and pajamas across Zoom, and still have a conversation in these kind of times. I think it's super cool that we can do that.
Yes. So, Radhika, let's start off. When I read your tweets, in some of them you've made references to the 2008 crisis. So what exactly is happening? For someone, say, who started his SIP 3 or 4 years ago, with all the communication that has gone in, with all the awareness programs that have gone in, how does one make sense of what we are seeing right now in the markets? We are now in April. March, thankfully, is over. And it's been a really bad month. So just walk us through, just to answer the question, what is happening right now?
So I think, and I'll be a little honest, I think there are two kinds of investors. And I think the investor who saw 2008, which is why I make so much reference to it, is probably a lot more comfortable right now. But I think for the investor who's a post-2008 investor, the 2014 kind of investor, as you said, it is a confusing time. I will not take away from that. In fact, you are probably looking at the screen and wondering, what is going on? I think the first message I want to tell the investor is this is reality. It had to happen. Now, whether it happened in 2020 or 22, or whether it happened because of a war or corona or some reason, this was going to happen. Once in a decade, once in 15 years, once in 10 years. And by the way, I do believe that these so-called events, meltdowns, black swans, as you call them, they're actually going to get more and more frequent in the world that we live in. So this has to happen as part of your journey. And I always tell, young Anupam investment analysts who join me that it's very popular to say in the investment professional, you have to see a cycle. Or I want to tell investors, you have to see a cycle. And this is your time to see that cycle. And the cycle is not easy, but the cycle is going to teach you a lot. You're going to become a much better investor after that cycle. I mean, I was slapped personally as an investor in 2008.
Talk to us about that. Let's make this pause. Let's tell us about how you went through that. What was that like?
It was very interesting. So I started earning in 2005 and I started saving in 6, obviously. And you take a little bit of time to get into the mold of investing. And I have to admit, I was 24. Bonuses were really good on Wall Street. And I was like, okay, let's put this all into equities. I thought I was much smarter than I was. I'm going to convince Wall Street professional, etc. So put 100% of my money into equities. This was 2006-07. So it was great. And I was like, I'm young, I should just do equities, whatever. And everyone was doing it. And then Anupam 2008 happened. And now what happened to me is, not only did my portfolio value half, I worked for a company, an asset management company whose AUM halved. My husband is also in the same profession. He worked for Goldman. Goldman's stock collapsed. Our bonuses collapsed. The returns of our funds collapsed. So everything collapsed together times 2. And then incidentally, we had to move back to India in 2009 because we took that decision. And when we had to move back, we redeemed the funds, obviously at substantial losses. And for me, that was my first big realization that, listen, I am basically very levered to markets. I'm like a 5x bet on markets because of who my husband is as a household. And so my personal finances have to be super conservative. And I learned about this then. And so now I make sure that my investments, and I can talk about more there, are actually far more conservative, even though I'm a markets professional. So I hold a lot of conservative instruments because I realize that the rest of my life is very, very aggressive. And that's why I'm a lot more comfortable in 2020. It's a much easier crisis for me to handle financially than 2008 was.
Okay. So messages now, in the sense that just an answer to the simple question, what should we do? And you can break down the category of investors any way that you can. You can look at someone who has, for example, whose SIP is 3 years old, 5 years old. I think even 10-year SIPs aren't doing exactly great. So I wanted to talk about 2 specific aspects. One from your own experience, which is asset allocation. Mm-hmm. And the second is, what should I do now with my SIPs? Let's just answer those 2 very specific questions. What should I do on asset allocation?
And, before you do the asset allocation and SIPs, I think for 80-90% of the world, the first thing you should not do is react dramatically. I've said this on social media itself. There's a beautiful quote that, when you're stuck in a storm, it's not a time to make big strategic decisions because your mind is very clouded. Even as a CEO running a business, this is not the time to make large portfolio changing decisions because your thinking is very colored. And in a crisis, in a bull market, we tend to paint a very rosy picture of the world. In a bear market like this, you tend to paint an overly pessimistic picture of the world. So the minimum I want to tell people who are listening is don't react dramatically because you're probably going to take extreme steps that are not good for you. I actually see transactions on of people not only cancelling SIPs, but taking money and moving it from small cap funds to overnight funds. I mean, this is just sheer fear. And that shouldn't happen because right now, remember, the losses that you see are notional. when you press that exit button and act, those losses become real. So don't act. That's step one. For an SIP investor specifically, what you will feel like is my returns are super negative. Remember why you did the SIP. You probably did the SIP for a goal. That goal was a long-term goal. It was probably a 5 to 7 year goal. Keep that goal in mind and don't react. Don't stop your SIP. Obviously, if you have income or job challenges, then things are very different. But remember, you did SIP so that you could actually accumulate more units through this market correction. So please don't go out and stop your SIP if your circumstances let you not stop your SIP. That's the biggest disservice that you can do to yourself. Have the courage to get through. I also want to tell you that, there are lots of these messages that float around saying SIP investors have not made any returns for the last 4 years. Don't measure equity performance at the bottom of a cycle or at the bottom of an extraordinary event. It's like me telling you, Anupam, if you were a salaried employee, I'm going to do your appraisal after the worst month you've had in the year and just judge you basis that. That's probably not such a good idea, is it?
No. So Radhika, I think that's a nice comprehensive answer to begin with, that right now when you do anything, you're actually making notional losses real. As you said that you actually know people who are probably stopping a mid cap or a small cap SIP and putting it into an overnight fund or whatever. That's when you're actually, making the notional losses real, and that you should not be comparing something like an SIP, which is a long-term product, when it's at its worst cycle. We've got that part, and I am continuing my SIPs. That much I know for sure. I don't know about the listeners, but I hope that your answer has helped them through that. Tell me about the brave. Some people who say that, okay, why don't I start an SIP right now? Tell us about your thoughts on that.
So I think, look, there is, the old saying about being greedy and starting to invest when markets collapse is a very valid one. I would also say that obviously markets are a game. I mean, someone told me very interestingly today that mutual funds are not like buying soap. When when you buy soap that, you'll wash yourself and you'll smell nice. With mutual funds, it's a little bit of a risk reward, right? Either you'll make money or you may not make money, right? I found that interesting. Now, your chances of making money, if you invest after the market has fallen 20-30%, are probably better than your chances of making money if you invest after the market is up 20-30%. I mean, this is just basic common sense. And I mean, this is common sense that everyone reiterates. Obviously, the challenge of investing at a time like now that people commonly face is, look, the markets are down 30, I invested, and what if they fall another 10%? I would say this, that, there are great opportunities that are coming. There are companies that are down 50, 60, 70%. And, obviously funds are down that much. So there is an opportunity to invest. If you're investing, one, be prepared that you're not going to time the bottom perfectly. Nobody times it. The best of fund managers don't. So if you're investing, be prepared that you could lose another 10%. But look, if you're investing over 5 years, you've got things, and you've got things at a 30-40% discount. Now, if you didn't get a 70% discount, just keep that in mind. Second, you can also stagger your investments. SIPs are a good idea to start. If you're doing lump sum investments, we've also told people that if you don't want to be completely heroic but want to start getting your feet wet, the 3-month STP is a very good option to look at. So that's also something that you can do, because, that will smoothen out a little bit of this volatility. It's very hard to predict, Anupam, what will happen when this COVID-19 threat will get over, whether things will bounce back super sharply. So in 2001, markets fell and the bounce back happened in a month. In 2008, it took a year plus for the bounce back to happen. So no one can really time that. In that sense, an STP helps you a little bit.
Okay. There was some very interesting data that Niranjan from Edelweiss had shared, I think yesterday. His tweet reads like this. You see, he says, gaining from downside protection since year 2000. And I'm just stating the facts, listeners. This is not any opinion. This is not anything. These are just pure facts. This is past performance, where he says that since year 2000, markets have clocked negative returns for 6 years. In 2000, it was down 13%, 2001, minus 15%, 2008, minus 51%. 2011 minus 23%, and 2015 minus 3%, and 2020 year to date we are down 29%. And he's saying by protecting just 10% of downside in these years, your portfolio returns would have been 184% higher. Can you just make this a bit simpler for our listeners, Radhika? Because we're just talking about past data. This is not about what's going to happen in the future. This is not. I just want to understand this very interesting research data point better for our listeners.
So I'm going to simplify the same point that the data is trying to explain with a very basic mathematical example, Anupam. And I think it's a very powerful example. So if you have 100 rupees and your 100 rupees becomes 25 rupees, right? To go from, or your 100 rupees becomes 80 rupees, sorry. So you've gone from 100 rupees to 80 rupees. To go back from 80 to 100, so you lost 20% of your money when you went from 100 to 80. To go back from 80 to 100, how much do you need to make back? You need to make back 25%, right?
25%, yeah.
Now assume your 100 rupees went to 50 rupees. So you lost 50%. To go back from 50 to 100, back to your capital, what do you need to make? You need to make 100% return. In the first scenario, you lost 20%. To win back to par, just to where you started, you needed to make 25%. In the second scenario, if you lost 50, to go back to 100, you actually need to double your money. And what Niranjan is trying to say with that data, which is something that we say, is it's very important. And this is where the whole point of asset allocation comes in, to control your losses. Because one of the challenges is that if your losses are so hard to bear, then coming back takes forever. And a lot of people just don't have that staying power. I mean, there's a beautiful example from history that one of the reasons that Russia is so conservative as a country compared to the US is that both of them won World War II, but Russia lost 10x the number of soldiers that the US did in World War II. So sometimes crisis, if you lose too much in a battle, it's very hard to continue. Your losses can't be more than you bear. And that's what that example is trying to illustrate with the help of simple math. And that's why we keep making, by the way, that point about asset allocation, that if your overall portfolio is down 50%, you have that human tendency to just say, forget this all, I'm never investing again, I'm sitting in the bank, I can't handle this. But if your portfolio is down 10, 15%, somehow you emotionally have staying power.
Wow. So just walk us through that. This is such a powerful point, because people for some reason refuse to look at portfolio level performance. They are just so caught up with this market is down 30% and this and that. I want to wrap up this episode on this exact point, asset allocation, because there is one group of people who believe so much in finding the bottom and investing in the bottom. Maybe it's an ego thing. But what I've realized is, any stock that falls 50% can then fall 90%. So each time that you think that you're actually buying something cheap, you don't know what's going to happen next. And that's why portfolio performance, and that's why asset allocation makes such a big difference. So just walk us through your entire thought process on this asset allocation framework, which I think, times like these bring out the importance of asset allocation. Maybe it's once in 10 years, but when you see your portfolio's hit is just 10, 20% because, you were smart enough to park some money in a debt fund. I don't know. So just take us through that.
So I think asset allocation is a big word, but actually it's very simple. It's just not putting all your eggs in one basket, and that one basket is Indian equities. When you do asset allocation, what do? You take your 100 rupees and you put maybe 50 in equities, you put some amount in fixed income, you put some amount in gold, maybe you put some amount in some dollar investments, because by the way, the rupee has also collapsed. Now, a lot of people think, why do I need to do this? I have a 10-year holding period. Equities is the highest return asset class. And, why do I need to have any debt? And
exactly.
And then these years like this happen, and they look at their 100% equity portfolios, kind of like me in 2008, Anupam, and they're like, okay, I need money to take out, but damn it, this is 50% down. Should I take it out at a loss? Now, when you have a portfolio that has some element of debt is providing that cushion. So 50% of your portfolio may be down 30%, but there's some part of your portfolio that's actually up 3-4%. So on an aggregate basis, you're sitting at 20%. And if you need to take out some money for some expenses or some crisis, life is uncertain. And times like these are uncertain, by the way. Then you have that debt portion of your portfolio. And also, 20% gives you staying power that 50% doesn't. We are human, we are emotional, and there's a certain amount of panic Asset allocation helps you control that panic. In a sense, I feel like it's that thing that lets you live in the market to fight another day. And a lot about investing is just being there to fight another day and a week and a year and times after that.
Okay, Radhika. So I think, some very important lessons from whatever you've said to us so far. I think the first one to me was a very good one, a very important one. That is, don't do anything in panic. If you're selling out, just because you're seeing so much of red and so much of losses in your portfolio, just think for a while, because then you make the notional losses into real. So I think that is the one lesson, that you want to just think and pause and reflect. Doing anything in panic might not be the right decision. That's the first one. The second one is understand the math of when a stock falls or when your portfolio falls. Like Radhika said, when you go from 100 to 80, it's a 20% fall. But when you go from 80 to 100, it's a 25% rise. Okay, so understand how that works. That might help you to, understand how asset prices move. And the third one is asset allocation and the importance of diversification at a time like this. Okay, so you want to look at different assets. Now, what those assets are would depend on your risk return profile, where you are in terms of your age and all that. So you might just want to think about that, put a pen and piece of paper or an Excel file and figure out your asset allocation. We don't give specific recommendations out here, and I'm actually not sorry about that, because that's one thing for Paisa Vaisa. We're not out here to give recommendations. That's for you to figure out on your own. But I think the knowledge is something that we would definitely like to share with our listeners. And I hope that Radhika has conveyed a lot of these important messages to you. Last question to you, Radhika. Yeah, my WhatsApp groups are just full, so it's so extreme. There is one group which is saying, this is a bottom, buy this, buy that. The other is saying, no, this is the end of the world, this will happen. And then there are all kinds of rumors flying in the air. My God, sometimes for someone who's not accustomed to this kind of a sheer flow of stuff, how do you navigate this? News, rumors, what do we do?
So we are in, and I'm glad you asked me that, we are in a world that is surrounded by news. I mean, my husband and I were just discussing, we're both capital markets professionals. Both of us have individually exited about 10 WhatsApp groups in the last 2 weeks.
Okay.
I'm not kidding, because there are so many messages on COVID, which is a very serious issue. And I only want commentary on that is genuine and factual, and very few people have factual things to say about it, and medical professionals do. And similarly on the markets. And my recommendation to people is honestly to watch a little less news, and also to look at their portfolios, Anupam, a little less. If you looked at your portfolios once a quarter, you know what the news does? It tempts you to look at your portfolio every day, and that's just going to spread panic. So news should be relevant to your portfolio. If there's something material that's happened in mutual funds and you are an investor in those funds, by all means, you should be taking action. If there's something that's happened in a bank and you're a customer of a bank, by all means, you should be taking action. But random news for the sake of public watching news, I would encourage you not to believe rumors about anybody, any organization, anything. If you have facts, ask questions. There are enough resources in the world of social media that you will get an answer from the horse's mouth. Do not believe extreme optimism. Do not believe extreme pessimism. These are times to listen to people who are a little balanced. And if you can't find people who are balanced, then shut off. But extreme optimism and extreme pessimism is probably not good for you. I am going to narrate you a tiny story that I think might help. There's so much advice floating around on how you should manage your money and who you should be. So I had shared some part of my personal story on investing and what I had done, similar to what I had narrated to you, Anupam. And someone came back to me and told me that you have a very conservative investment style. What would Warren Buffett say if he heard about your story? Because he believes in 100% equities. And I wrote to that person, I said, actually, with all due respect, it doesn't matter what Warren Buffett says, because my circumstances are very different from his circumstances. He's a billionaire with a certain net worth and a certain set of circumstances. I am me with my own circumstances. And I think that's what I would communicate to listeners, that you have your own set of circumstances. And ultimately, Anupam, you said very rightly, we don't give advice. Your personal finances are a function of your circumstances. So let's listen to the stuff around you, but take decisions that are right for you. I do believe in investing. You don't have to be a guru. You don't have to be a trader. You don't have to be Warren Buffett. You just need to make sensible investment decisions with a little bit of common sense and a little bit of good principles. And that should be about it.
I can see from your timeline, you're my God, you're getting a lot of questions right, left, and center, Radhika. And thank you so much, for actually keeping communication lines open. I think that's great. That is something we did not have in 2008. I was also there at that point of time, and I remember that we didn't have this option to actually directly ask fund managers and people from the industry our questions. So thank you so much for doing that on your social media timeline, and also for doing this recording for us, folks. That is a wrap on this episode of Paisa Vaisa. The key messages: do not panic. Think. Number 2, asset allocation. Number 3, diversification. And number 4, mathematics. So you want to just think about all of this, all of what you've heard, and please be very well informed before you take any decision whatsoever. Do all your research, do all your homework, and then do whatever you want to do, honestly, because we out here believe in giving you the necessary information and perspectives that could hopefully make you make smarter financial decisions. That is the wrap on this episode of Paisa Vaisa, folks. We are trying our best to have guests on the show, and we hope to have new episodes for you every Monday. Stay safe, guys. These are really tough times, and I hope that all of you are staying safe, staying healthy, and I wish us all the very best that these times get over really soon. Radhika, thank you so much for doing this for us.
Thank you. Stay safe, stay happy, stay smiling.
Thank you, Radhika, for that end note of optimism.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Advertising is dead. Yep, you heard me right. Advertising is dead. We're all in the content business now. Let's not call it news, TV, radio, etc., etc. It's all content, and we're in the middle of this weirdly exciting phase where all the borders and lines that have been drawn over decades has been swept away by this lovely thing called the internet. We're a show where we don't dwell on just the stuff that is now, but rather the wider stuff about advertising, media, content, and the whole goddamn circus surrounding it. Tune in every Tuesday for our weekly unboxing of the mystery box we used to call advertising. I'm Varun Dugirala, co-founder and content chief at The Glitch, and this is my new podcast, Advertising is Dead.
Welcome to Peak Planet, a new podcast where we delve into the fallouts of the growth path that we, and indeed much of the world, has chosen. Sustainable growth is the buzzword. Until we nail that down, we need to ensure that we keep our population healthy and also have the resources for our increasingly urban lifestyles. I'm Karthik Ganesan, a researcher at the Council on Energy, Environment and Water, a Delhi-based policy research institute where for almost a decade we've been trying to explain and change the use, reuse and misuse of our resources. In the first season of Peak Planet, we take up air pollution, public enemy number 1 and an invisible one at that. Increasingly, the most important risk factor for adverse health outcomes, air pollution has become the most unwanted byproduct for an aggressively growing economy. Over 4 episodes, we find out how prepared our systems are to deal with this crisis. You can catch the entire first season of Peak Planet out now on the IVM Podcasts app or website, or wherever you get your podcast from.